Welcome to Beyond Rent, the property management podcast brought to you by Rent Manager. Each episode, we sit down with an expert to talk industry updates, tech solutions, and top tips for those in the property management space. And now, let's get to the conversation and go Beyond Rent.
Hey everyone, and welcome to Beyond Rent. In property management, financial decisions are made every day. Many of those decisions are based on how to best use funds. But what happens when there aren't any funds available? Today, we are talking with Tom of Ryse about getting access to capital to ensure your property can be successful and you can continue to grow your company. Tom, welcome to Beyond Rent.
Thank you very much, Joe. We and the whole Ryse team really appreciate you having us, and we can't wait to talk about what you teed up.
Absolutely. No, this will be really great. I appreciate you coming out and having the conversation with us. There's lots of things that are going on in property management, people wearing lots of different hats. And some of these things can be really challenging as far as decisions when you don't have the money available to make those decisions. So excited to learn more about how you're helping with that. Before we get there, let's get to know you a little bit better. So go ahead and introduce yourself and tell us what you're all about.
Great. Thank you. So I'm Tom Smith. I'm a co-founder and the chief revenue officer of Ryse. My background in the Wayback Time Machine is mechanical engineering, and then I worked in internet security in the early days, and then wanted to get into brick and mortar. And so I'm a recovering developer. I built multifamily homes in the Dallas area and in East Texas, single-family home communities. And so got to learn that business for about 15 years and really enjoyed it. And then kind of combined my technology background with real estate and was co-founder of a company named Truss. And our goal at Truss, based out of Chicago, was to disrupt both kind of listings, commercial listings, dominated by CoStar, and be able to also disintermediate the large brokerage firms for small and medium businesses that we felt were underserved. And so we built that business and sold that to Avison Young. It was at that time that I was approached by my co-founders of Ryse, Sean and Seva and Hirsch. Sean and Seva came from JP Morgan's chief investment office and had really developed and traded very innovative financial products. And they wanted to create new use cases and create new asset classes. And they were really, they had a high conviction that the real estate market was underserved for innovation in financial products, and found me. And I said, you're absolutely right. I just don't know how to create financial products, but I know people that need them. And there needs to be a lot of innovation in the space. And our co-founder, Hirsch, knows how to build those type of products as our chief technical officer. So really a unique combination of true real estate development and PropTech meets FinTech and combining forces.
Thanks for that background. I always love learning how people get where they're at and the different steps along the way and who they meet and their experiences. And I love that you shared that you didn't have really the fintech side of things figured out, right? But you knew the industry and you knew people that could use these tools. You just needed somebody to help you build them, and that you found the right people, or the right people, I guess, found you.
That's true.
To bring you alongside and try to figure these things out. So I think as we have the discussion today, we're going to learn more about what that looks like and why that's important. But maybe a good place to start the conversation is to really frame up the problem that exists. So we talked about fintech needing to be involved more in our industry. Where is the problem where maybe owners, investors don't have access to capital maybe the way that they need when they need it? Like, why is that such a problem?
Well, it's a problem because the vast majority of real estate ownership is non-institutional. And a lot of people outside of the industry don't realize that. They hear the big names, the Blackstones, the BlackRocks, and these massive firms with huge balance sheets. the big home builders, the BTR institutional groups. But if you add all of that up, it's way less than 10% of the market. It's less than 5% of the market. The rest of real estate owners are either accidental landlords, right? Might own one or two properties that they didn't know they would be in the business, and then a lot of professional real estate investors that have rental properties. But the common denominator for 95% of owners in the United States is they are not sitting on an institutional balance sheet. So they're reliant on the traditional mechanisms available to people that own rental properties, which is different than for people that own their own home, as people know, and the mortgage rules are different for that. And then they have to rely on the consumer credit markets, just like any U.S. consumer. And so they really have been excluded from participating in where the intersection of institutional capital being available to non-institutional owners. And that is the marketplace that we've built, and that's the problems that we're solving for.
Thanks for sharing that, because I think that's really important. One of the things that you said a lot of people aren't aware of that are outside this industry is that these large institutional firms really represent a very, very small part of the industry. You know, call it mom and pop, call it whatever you want, but most property owners own 1 to 5 properties. They don't have all of these investors and all this capital sitting behind them to move and make decisions and handle all types of different financial situations that may arise. So when things do arise, they have to be able to figure things out. And sometimes that's really challenging because of some of the things that you just mentioned there. So I think that really kind of frames it up. And I think you said 10% of the market is institutional, meaning 90% of the market is not. And they're looking for tools, and they're probably going out in the market every single day looking for different financial tools to help them. And they're finding very little.
That's exactly right. And so what we wanted to do is make sure that we were providing a product that has a very definitive use case and need. And so where we really developed our initial product around a rent advance is the very real problem where if you own a rental property and something breaks, you have an upset resident who is reaching out to your property management company or yourself directly and asking for something to be fixed immediately. And many people are not sitting on a lot of cash waiting for things to break. And we wanted to be able to, we took that very simple example, which is a very real problem set, and said, how do we solve for that? As opposed to kind of esoteric, theoretical type of financial product, really where the rubber meets the road. How can we really help people in a new, accretive way that they don't have access to today? And that's where the idea of a rent advance comes from.
That's really a good way to frame things up. This idea that there's a known gap, right? There's a place where they're needing help, they're needing assistance. And you talked about not having a lot of available cash on hand. In most of these situations, regardless if it's 1 unit or several hundred units or even thousands of units, if they're not institutional, they're deploying their capital, right? If they have money, if they have funds available, these are people that understand that they need to invest to grow their portfolio. So they're not going to sit on tens of thousands or hundreds of thousands of dollars. They're going to put that money out in the market and try to get a return on it, right?
Absolutely. And so the most successful ones do just that, right? And so they're able to build a portfolio through excess cash flows of their existing portfolio. And when you're deploying that in that manner and then surprises happen, it can be really a wrench in the works, right? And so how do you make sure and support someone who is making sure that they're deploying and adding to their portfolio in a way that whatever they've built doesn't come tumbling down, right? Just because they have an episodic cash need. That should not be the reason why you have to sell a property when you have essentially a very tangible asset that has been undervalued by the market here to date. And that undervalued asset is your tenant lease. And so rental owners that have a tenant lease, essentially a contract for future payments, have a very powerful and valuable asset that they're holding that the market has not undervalued, just not valued. And so businesses get their accounts receivable valued all the time. So when businesses owe other businesses invoices, which is no different than a lease payment, a contractual obligation to pay, there are a massive financial network that supports businesses that need cash today for customer payments tomorrow. And that's called factoring. Accounts receivable factoring has been available to businesses as far as I have recorded history, but not been available to people that own rental properties that would like that same type of, essentially treatment and recognition that that's an asset too. And so that's essentially what a rent advance does. Is Ryse's investors say they want to be able to provide financing for those future receivables, and we at Ryse find owners that need cash and want to have future rents paid for tomorrow. And we primarily utilize property management companies to empower and enable them to offer this product to their owners. And the process is very simple. It's if you have a long-term primary residential lease, that resident is current with their payments, and there's enough natural months left in the term, we will advance up to 11 months or however many months are remaining on that lease to you at a 90% advance rate, so a 10% fee, and essentially you get that cash within a day or so.
So I want to dig in a little bit more, because what I find really interesting as I talk to different people is different products find our way in our industry, into our market in different ways. And I hear quite a bit of people that are in the industry, they've worked in it, they recognize a problem, and they go and they build a product to solve that problem, right? Because they're experts. They already know the industry. The other way things come into the industry is somebody that from outside the industry looks in and says, why don't you offer this? Why is this not already being offered? Like you said, this idea of factoring AR is common business practice in every other industry. But for some reason, and I don't know, and maybe you do know, the tenant lease was never looked at the same way that other AR has been in other industries. That has really limited the ability to do this in our space. But your company obviously is looking at this differently and taking that step forward. So to me, that part right there is just very, very interesting, that a common business practice elsewhere, our industry is just behind.
Right. And it goes back to how we opened the conversation, Joe. It's the large institutional groups that own properties, that 10%, they have the balance sheet for when things break. So they don't need to even turn to their bank necessarily. But when 90+% of a market is individually owned, right, the financial markets don't view that as essentially a business-to-business transaction and aren't solving for that. And so they're not, so individuals and even, their associated LLCs and the whole small, medium business rental ownership world is essentially just totally overlooked by the financial markets because they're not a large business transacting with another large business. And so it has fallen totally beneath the radar screen. It's just until it happens, it doesn't happen. And we think the reason why is because it's very typical for small businesses to be overlooked by large banks.
Well, and I actually think that's very true. And I don't think it's just banks either. I think in general, looking over small business is very easy to do. And I think historically, part of the problem was really just scalability, right? If you're going to serve small operators in any industry, there's a lot of effort that has to go into that. A lot of sales and marketing and operations and hand-holding and customer service that's all tied to meeting the needs of these smaller operators. Again, in any industry, not just ours. where I think we're finally at a point where technology is coming alongside of these solutions in a way where, meeting the needs of any size operator is actually very, very doable because the technology is taking place of all that effort that would have been humans in the past.
That's right. But it's also, you hit on this, and this is the reason why Ryse is here, and we are so excited to partner with Rent Manager, is because the property management ecosystem is so tuned in to solving the various use cases for this product and know exactly that dynamic between a resident who's unhappy because something needs to happen and an owner that is balancing their cash management system. We also know property managers are keenly aware that there's moments when owners want higher rents, right? They believe their property deserves higher rents. A property management company has great visibility on knowing the improvements that would need to happen to that owner's property to get those at market or above market rents. Well, guess what? That requires some type of capital infusion that's not coming in the normal flow, perhaps, right? So the ability to identify those use cases and make this a very tangible, practical product that is solving a pain point, not just a vitamin, but a painkiller. And being able to do that is why we believe not just creating the product and hoping people come, but it's more about rolling up our sleeves and working with the PMCs that really know what owners want, how to differentiate their offering, being able to solve for these problems without using their own cash, and be able to provide that type of service and be a distribution platform for this offering is something that isn't in a large financial company's playbook, right? It's because we're so laser focused on real estate applications specifically for this that I think will ultimately will make it to where it can finally get through that last mile to the person that needs it.
Yeah, and that's really the goal, right? Is understanding the market so well and those unique use cases that you build a product that is tailored to the industry versus looking outside. So maybe that's even a good place to kind of take our conversation is what is a rent advance, right? Versus maybe what else is out there, what a rent advance maybe isn't, because people are solving for this, right? But they're probably solving for it with products that just aren't as good of a fit as a rent advance might be.
Yeah. So a rent advance is a payment today for your future rents tomorrow as a rental owner. So we're essentially, our purchasers are buying the future tenant payments on your existing lease agreement for a payment immediately. And those purchasers are taking the collection risk along with the principal risk and return risk in exchange for a 10% fee, essentially a 90% advance rate. The product is really that simple. There needs to be an in-place long-term tenant. They need to be current on their payments, and our underwriting process is very tech-enabled, super fast. This is within a 24-hour process. The whole acceptance and then funding can occur. When we're working with a property management partner, we run our payment rails through the property management company's payment rails and don't disintermediate between the property management company and the tenant or the owner. So we give the advances to the property management company, who then forward them to the owner, and then the property management company does what they do all the time. This is not disruptive. They collect rent. If it's during the repayment period of a rent advance, they forward us those rents. And then when the repayment period's over, say, 5 months of a rent advance, 11 months, we do anywhere from essentially 1 month out to 11 months of rent advances. And so that's, we're just kind of fit within the ecosystem that already exists and the relationships that the property management companies have with both of their customers.
So that's really helpful to understand all of those pieces and how that works and how it all fits into the bigger picture of specifically the workflow or the payment flow that's already in place, right? Because the last thing you want to do is interrupt that for the tenant, the resident, the owner, the property manager. They already have this perfect little system created, and they don't want Ryse to step in or anyone to step in and impact that, right? So that's where I think sometimes when we look, I would say maybe at a more traditional way of getting funding is sometimes, I'm not going to say easier, but people might think it's easier, right? Like, well, I'm just going to go get a loan or use a credit card with super high interest rates to take care of this because then I don't have to worry about impacting any of these other elements. But you're saying your process is even easier because everything remains the same.
Right. So it's both faster and it's less expensive. Or total cost of capital is much, much lower. So so the alternatives to answer that part of the original question are very typical, well-known, but worth restating. So credit card, right? So can be relatively quick, but quite expensive. So I think the current rates now are over 25%, 25 to 28% is a standard aggregate average right now. So that's really expensive, especially when you consider a 10% fee on 11 months of future rent advances. The other option is to get a personal loan. That is longer, right? So that could be, that's weeks. That could be 4 to 6 weeks while the air conditioning's not working and your rental property in Arizona or the pool pump's not working, and that's what they're there for. So that's long, and then the other option is going through a refinance of the mortgage itself. That's a lengthy process. That's expensive from a closing fee, and it's interest rate sensitive. So our fee is not interest rate sensitive. So that's important. So as interest rates fluctuate up or down, it's really about the credit worthiness of people that pay rent in the United States. And so it's much more tied to that as essentially the collateral than on interest rates. So what's really nice for owners is when interest rates are high and when they're feeling squeezed on a cash basis, a rent advance is neutral and doesn't fluctuate when they're essentially can get squeezed on rates. And so it's flat, it's predictable, and so that's how it's different. So it's quicker, it's less expensive, and it's not tied to what a lot of the other consumer credit products are on the rate side.
Thanks for breaking down those alternatives, because I'm sure a lot of our listeners are thinking through those alternatives right now, maybe what they've done in the past or how they typically view things like this, maybe even through like a line of credit and things like that, right? That are all credit-based versus really just selling your AR is what you're doing, right? Which is a totally different play on the financial side. Something you had mentioned as well, you talked about the credit side of things. How is a rent advance tied to credit, and how does it impact somebody's credit?
Right. Well, I'm glad you brought that up because that's into the field of what a rent advance isn't. So what a rent advance is not a loan. It's a purchase of the receivables. So it is not a credit product. And so that's really important for owners to understand when they're utilizing it. And that's a really important feature of the product because what it allows, because it isn't a credit product, it allows in terms of use of proceeds of what you can do with your rent advance funds. You could do things like pay down high interest credit cards with those. You can pay off a personal loan. You could help clean up your credit reports so that getting the next financing for that incremental property or doing a refi that you've been wanting to do, say to take advantage of if rates had dropped or you just need to refi. You can use a rent advance and not have to wait each month for those rents to come in to do it in one quick move. And then a rent advance is not credit, so it's not showing back up on that same credit report that just got cleaned up by those proceeds. So it's really powerful on that side and is one of, it's definitely one of our top 5 uses for a rent advance is to pay off owners' high interest debts.
Yeah, that's something I would not have thought about. Like when you talk about different use cases, especially the one around, a large repair that comes out of nowhere, that one really makes sense instantly to me. Trying to make the resident happy, trying to make the owner happy, to try to keep the PM happy. That'll make sense. I never really considered this idea of using those funds to maybe, again, pay down other types of debt that have a much higher than a 10% rate attached to them to make good financial decisions, to put yourself in credit worthiness in different areas. So that's really, really exciting to understand kind of how that piece works. Now, let's talk about the PM side of things. So when you talk about a property manager, they really have 2 customers, right? They've got the tenant, the resident, then they have the owner, if they're a third-party fee-based management company. How are PMs viewing products like this? Are they seeing this as a help? How are they using this to maybe market to potential owners and things like that?
So this is the huge opportunity set that we hear from PMs. One, they want to be able to differentiate their offering to the market. And so by being able to offer a product like a rent advance that dovetails in with their normal customer relation flow, both on the resident side and the owner side, is very appealing. So they can win new business by saying that they can offer rent advances. The way we've structured the product is PMs don't have to pay, say, per door or per unit that they manage, just for the privilege of being able to offer rent advances. So we make that go away. So there is not a fee per unit to offer the product. And in fact, we pay and incentivize the property management company a fee that they earn, a performance fee, as they collect the rents for a rent advance. They can earn 2% of those rents that they collect. So in theoretical world, if all of their portfolio had an active rent advance, they would literally be adding 2% to their current fees at essentially 100% margin. So there's a massive financial incentive, not just differentiation to win new business, but a highly accretive, high margin fee that they can add in while they're saving the day of helping helping fund repairs, helping fund property enhancements to improve rents, and everything we've talked about. To give you an idea what that can mean, one of our early adopter property management companies, a fairly large group, 2,000 doors in the SFR space, by the end of their first year of offering rent advance, will be earning over $30,000 a month in our 2% fees for the rent advances on their book of business. So they didn't have to add a person to administer or to market the offering. We do that. We help them. We co-brand or just white label the offering through the PM. So the PM doesn't have to add resources, can offer the product. We do essentially the heavy lifting and utilize outside institutional capital to flow through them, and then they're incentivized with the 2% fee. But it can be very meaningful, is my point, and very quickly with adoption.
That is meaningful revenue, right? And what I love about this concept of empowering the PM to solve really complex issues. There's a lot of talk, and you mentioned SFR, but I know in talking with you, this works in multifamily, manufactured housing, any type of long-term residential. But when we think about the SFR space specifically, there's always a lot of conversation around how to retain owners. And just like residents, maintenance issues, right? Upkeep of property is a lot of times a key decision point for owners. So if I own a property and there's a large expense that I need to take care of, even if I decide to go ahead and take care of that, if I feel a little put out by the overall cost, I may make the decision to either move to another property management company, because I may try to blame the PM, right? Which is common. Or I may just say, you know what, maybe this business isn't for me. This expense was a lot. I'd like to recover some of these costs, so I'm just going to sell the property. Either way, that PM will lose an owner. So they're constantly talking about how to retain owners. And you're saying this is not only a way to retain owners, but it's a way to offer them something that other PMs aren't.
That's exactly right. What the data shows, PMs that offer rent advance to their owners, an owner, 40% of their rent advances do another rent advance within the next year.
Very interesting.
Okay.
So not only do they like the product, but they're repeat customers.
They end up self-selecting, right? Remember, this is at everyone's option. The owner can decide at any point in time whether they want one and how large of a rent advance they would like up until the remaining term on as many of their properties as they'd like that have that are occupied. So that's what's so fascinating. And so the reduction in churn is as valuable or more valuable actually than the winning the new business, which you can lead with a rent advance because you're checking the box on a lot of the other more commoditized services, even though you might have some differentiation there. But you can really add differentiation with a rent advance. And then the fact that it's a peace of mind product, I think is really something I'm glad we're having an opportunity to talk about, because that's what I hear more is when we talk to the PMs, we say, okay, what are your customers saying that aren't using it? Is this a factor when they renew with you? And they said it's this peace of mind that they know essentially they can fall back on the ability to instantly activate cash, get liquidity without adding a loan or to themselves or to the property. And the fact they know that they have that ability and they're not paying for it on a monthly basis for that ability is a massive piece. And so even when they're not using it, what we've been told is that they're renewing because they know they have it. And so that's another powerful piece. And that the idea of then going to a PM that's not offering a rent advance when you need it is something you'd have to factor, right? And hope nothing happens or hope your needs don't change. So all being equal, it's completely accretive.
Yeah, well, and to think that nothing will happen is like everyone knows something will happen. It's just a matter of time. And I'd imagine, and like you mentioned earlier, and where markets are changing, you really can't predict with a lot of confidence where things will end up as far as interest rates, things like that, what's going to happen in these different situations. To know you have access if you were to need it is really powerful. And at the end of the day, most of these owner investors, they want that peace of mind that you talk about. They are not looking to manage the property. That's why they hired a property management company. They're looking to own the asset and do as little else with it as possible, right? They really want to kind of pass all that off. They just want that PM to provide the services and products that make it as easy as possible for them. And I definitely see this fitting in to that bigger picture of what they can offer. Because like you said, a lot of PMs, at the end of the day, especially you really can't gauge service sometimes when you're first signing up with a property management company. That's something you learn over time. But what their actual offering is what you can compare. And if you're comparing two PMs, this could be that one item that stands out.
Absolutely. The other big use case for a rent advance is being able to provide equity for new acquisitions and being opportunistic. So if a rental property pops up on an owner's radar and they'd like to add that property, but they need to act now, and let's say they have a few other rental properties, they could take some rent advances from each of those other properties, pool that together, and blend in that capital with whatever other savings they have, or use it entirely as the down payment for that net new add. And so if you look at PM surveys, a lot of times they'll talk about they want to be able to help do portfolio management and growth, right, for their owners, right? If their owners grow organically, that is way easier, right, to build a business and increase margins and reduce your acquisition costs and so on. And so by offering a rent advance, you could then build like essentially tools to help manage the growth or enable new growth for your owners that are in an acquisition mode. And that's a lever that you wouldn't have without offering that. So some of the sophisticated PMs are seeing, how do I combine this? I want to be able to advise them on how to grow. But if I don't have a way for them to generate cash in kind of a new way outside of all the existing options, which of course are on the table and they should be. And it's not an all or nothing, right? Like I said, it can be a blend, but it's a new option, right? And it allows you to essentially kind of be able to pounce on opportunities in a way that lengthy loan processes wouldn't, is that organic portfolio growth management, utilizing a rent advance, and being able to turn those dials is extremely powerful. So that's really that kind of that fifth use, right? If we think of unplanned repairs, enhance, building or house enhancements to increase rents, paying down other credit, acquiring new properties, right? And then just being able to use for personal reasons, right? So that's kind of the catch-all use case. So and that the non-restriction on fund use is appealing.
Yeah, I can imagine, right? It's very freeing. And that conversation around acquisition, I think, is really important, because when I think of property managers, in some of the conversations that I hear, a lot of them are shifting their mindset. They're saying we're not property managers, we're portfolio managers, right. We're asset managers, or at least that's what they aspire to be, because property manager feels more like a commodity, right? Anyone can do this, quote unquote, right? It's a hard job, but there is this idea.
Do it well is
do it well.
Sometimes different.
But there is that idea that anyone can do it or they're a dime a dozen. That's not really true. The good ones are worth their weight in gold, but the really good ones are trying to set themselves apart by being more than property managers. And this is where they could walk in and say, hey, I know you own these 2 properties and these are great, we're doing a good job, but have you thought about acquiring more? And if they say, well, I really don't want to do this or that with these types of market conditions right now, I don't want to put my money here or there, a rent advance could be a great way for them to leverage what they already have to move into a 3rd, 4th, 5th property. And before you know it, like you said, that organic growth
right.
of a happy current owner, that's powerful.
Yeah, no, that's exactly right. And that's what that whole exploring all that opportunity set and being able to communicate that to owners and about what they could use it for, and really partnering with the PMs about how can we, make you look good and be able to offer this type of innovation and be ahead of the curve is really where we feel the real power is working so closely with them.
Yeah, it is definitely a powerful product, and I know we've already talked about this a little bit, but the one element for the PM, in addition to the revenue and in addition to adding all the value on the owner side, is also being able to keep those residents happy. When we talk about resident retention, maintenance issues are typically number 1 on the list for why people move on when the lease ends. If things aren't handled quickly, appropriately, if they have to have multiple repairs, that's why people move on somewhere else. People don't like to move, right? If they're happy, they want to stay.
That's
so
right.
You can keep them there. And this is just another, like you said, tool to help with that. I know we talked about that one earlier, but I think that's a really important one, because resident satisfaction is something the industry is focused on. We don't want to replace those residents.
That's right. And the PM is put in a really tough spot, right? Because they have two phones at all times, right? The resident's upset because something's broken or amenity's not working, or something like core, like air conditioning we talked about. And then on the other side, right, the owner doesn't not want to help, but many times they can't. And so they might not reveal that they're short of cash, is why they're not answering the PM's phone or emails, or they're dragging their feet. It's many times it's a very practical thing that the cash just isn't there, mm-hmm. and they're trying to figure that out, and they want to figure it out. So we want to help them figure that out easier, right? And at least be an option. Again, it's totally up to them. But right now it's not. They feel they're boxed in. I think, in many ways. And they might have credit cards tapped out. They might not want to touch the savings that they have for very good reasons. And so it's how do we essentially break this log jam by offering something, liquidity that never was offered to them before. And so it helps the PM save the day because there's always this tension. And so that's where we think there'll be a lot of momentum, and that's where we're seeing a lot of the growth that we're seeing is by solving just such a elemental problem.
Yep. And the fact that you are seeing people use these on a cycle, I guess, where they are coming back and using these again, mean they did prefer this means, because if they didn't like this type of product, they'd go find the fun somewhere else, right? They'd go back to using the personal loan or the credit card or things like that. So, well, Tom, as we kind of turn the corner towards the end of the episode here, I want to dive in a little bit more on Ryse specifically. I know we've been talking about the product and how it works, but if there's any details that we left out, anything that the audience really needs to know about Ryse, how you're structured, how you work, let's dive into that right now.
Great. Thank you. So Ryse started at the beginning of 2024. We're a Y Combinator company in the winter 2024 class. So we're very fortunate and very grateful for being included in such an incredible incubator and to have that network behind us for bringing this to market. We are based in New York City. We have over $150 million of capital market commitments to deploy just for the next couple of quarters here. And so we're very happy that we solved for that, the supply side. And now we're excited to activate the demand side and through partnership with Rent Manager and being able to get this product in the hands of as many PMs as possible. And we've already deployed $10 million of rent advances, and we've done that in 40 of the 50 states already, just this year. So we developed the product in 2024, and we came kind of out to market in 2025, and we've been growing fairly quickly, about 11% a week of the demand. And we're seeing a lot of kind of pull through. So there's a lot of word of mouth with owners and with PM. So PM to PM, there's word of mouth, especially ones that aren't necessarily competing in the same region. So they'll tell their other friends in other markets, right, about it. And then owners tell their other owners and about it. And so it's been very grassroots, the growth so far, and we hope to really take it up a massive level with our partnership, and we're excited to go.
Yeah, we had talked earlier about the need for education with a product like this not being available in this industry to date, right? This is kind of a new model. A lot of education has to happen because they may make natural assumptions of what this may be, if it's a traditional loan or credit product, that this is truly something different that they can offer, they can generate revenue from, they can solve tons of problems. So super excited. We've worked with other Y Combinator companies in the past, so we've always had really good success. A lot of great people come out of that program. I think they only accept good people, right? That's kind of, I think, the way the math works there.
Well, you're too kind. But no, it was a great base to build on for sure. And on the education side, I think it is important. So we spend a lot of time building marketing collateral, FAQs, and product descriptions for property managers to utilize off the shelf. So by partnering with us, I kind of like have to jump into the deep end to be able to try to figure out how to articulate this to your owners who you've built a relationship with. We will help you do that, and we can do that completely through you. We can also do that out of band if you're would like to run the campaigns and have us run them for you with your branding coming through your infrastructure. Whatever way we can be at whatever level that the PM is comfortable for of being able to get the word out, because ultimately if our owners know that they offer this, they're going to renew at a higher rate and they're going to get new business. And so we don't want them to have to kind of start from scratch. So education is the biggest thing, and it's a very simple to articulate product, as I described, extremely transparent. 10% is 10%, 90% of the future rents is the same thing, and that's it. So it's and 2% to the PM. That's it.
Yeah, when you keep it simple, it makes it easy to say yes, right?
Yeah.
That's kind of the goal there. So, wonderful, Tom. So if our audience wants to reach out and learn more, what's the best way for them to reach you or the Ryse team so they can learn about really how this works, maybe dive in deeper, or even sign up and start offering this?
Yeah, so you can always reach out to me, Tom, at Ryse Market. We're RYSE market.com. You can visit us at rysemarket.com and would love to hear from you.
Perfect. Well, we'll drop some links into our show notes so people can easily find that. Well, I really appreciate your time today.
Thank you so much. I really appreciate being here and love your headquarters and look forward to a wonderful partnership.
Absolutely. No, I really appreciate it as well. It's been a great conversation. And as always, I want to thank you, the audience, for listening to another episode. And until next time, keep going beyond rent.
Thanks for joining us for this episode of Beyond Rent. If you enjoyed this podcast, spread the word on social media and with your peers in the industry. To be notified when more episodes are released, subscribe using your favorite podcast player. Beyond Rent is brought to you by Rent Manager Property Management Software. Learn more about Rent Manager's industry-leading software solutions at rentmanager.com. Until next time, keep going beyond rent.